We are covering the complexities of VA loans for the national portion of the real estate exam. This is a government-backed financing option that is guaranteed by the Department of Veterans Affairs. It is vital to understand for the exam that the VA does not typically lend money directly to the borrower. Instead, they provide a guarantee to private lenders such as banks or mortgage companies. This guarantee protects the lender against total loss if the borrower defaults on the loan. On your exam, you must distinguish this from FHA loans, which are insured rather than guaranteed. This distinction is a frequent source of trick questions. VA loans are available to eligible veterans, active duty service members, and certain surviving spouses. One of the most significant benefits tested is the zero down payment requirement. This allows for a 100% loan-to-value ratio, which distinguishes VA loans from almost every other financing product. You will often see questions asking which loan type allows for no down payment, and the answer is almost always the VA loan. Another key feature is that VA loans do not require a monthly mortgage insurance premium. While FHA loans have mortgage insurance premiums and conventional loans with low down payments have private mortgage insurance, the VA replaces this with a one-time funding fee. This fee ranges from 0.5% to 3.3% of the loan amount. The exact percentage depends on factors like the veteran's length of service, their down payment amount if they choose to make one, and whether they have used their VA benefit before. The exam might ask about how this fee is handled, and the answer is that it can be paid in cash at closing or financed into the loan amount. When it comes to qualifying the borrower, the VA is unique because it does not use a front-end or housing-to-income ratio. They focus heavily on a back-end ratio, which is the total debt-to-income ratio. This ratio is generally set at 41%. In addition to this ratio, the VA uses a residual income calculation. This ensures the veteran has enough money left over for basic living expenses after the mortgage and other debts are paid. This dual approach to qualification is a specific detail you should remember. To verify eligibility, a veteran must obtain a certificate of eligibility from the VA. To determine the value of the property, the VA requires a certificate of reasonable value, which is commonly referred to as a CRV. The CRV acts as the appraisal. If the purchase price exceeds the value stated on the CRV, the veteran has the option to pay the difference in cash, but cannot borrow more than the CRV amount. You should also be aware of the rules regarding loan assumption. VA loans are generally fully assumable, but if the loan was originated after 1988, the lender must approve the credit of the person assuming the loan. A common trap on the exam suggests that only veterans can assume a VA loan, but that is false. Non-veterans can assume these loans if they qualify. However, if a non-veteran assumes the loan, the original veteran's entitlement remains tied up in that property until the loan is paid off. To help you remember the core benefit of these loans, use the phrase, VA is very accessible because it allows for zero down payment. Focus your study on the fact that these loans are strictly for primary residences and cannot be used for investment properties. If a question asks about a veteran using a VA loan for a vacation home, they are looking for you to identify that as a prohibited use. By mastering these specific ratios, fees, and certificates, you will be well prepared for any VA loan questions on the national exam.